JP Morgan Chase, Bank of America, Citigroup, and Wells Fargo. Today I'm going to compare all of these four great banks against each other. Hi, if this is your first time to my channel, well, welcome. And my videos are all about lucrative investments that anyone in the world can make. People invest in the stock market all the time, mostly because people just tell them they should. So I'm trying to help people understand what it is they're actually buying. It's actually taken me days to make this video, so if you could hit the like button for me, that'll help me grow my channel and I can make a lot more videos like this. And today I'm going to tell you which of the big four American banks you should invest in. Maybe you should invest in all of them, none of them, or the best one. Now, banks are sometimes considered evil, and in the past there actually has been some kind of evil people working in the bank. But that's not totally fair on the role that banks play in our economy, because without the banks, we wouldn't have had 150 years of amazing growth in our economy. A good banking sector is the cornerstone of a strong economy and makes a prosperous country. A very logical argument to investing in banking shares in the first place is that if you already have a bank account, well, you're probably only getting 1% interest. Well, the dividend from the bank that you're probably putting your money in the first place is paying probably 3, maybe 4%. So if the bank was to go bankrupt, not only would you lose your savings, but you'd lose your investment. So you may as well get the 3 or 4%. I understand that argument, but there's actually a lot more to it than that. So banks make their money primarily through lending at a higher rate than they give to the depositors. And they have gone through a lot over the past 150 years. They have pulled through crises many times before. There have been 10 major banking crises over the past 150 years, and the most recent being 2008. Well, there is kind of a crisis right now, but we haven't got through this one yet. Banks have been really important for the last 150 years, but do we think they're going to be important over the next 20? With the rise of cryptocurrency, online banks, and very heavy competition, are we seeing the end of the dominance of the big banks? This will all just be my opinion, so please don't act on my advice, do your own research, and make your own decisions. I'll address cryptocurrency first. So my opinion on cryptocurrency is that it is very useful, but it is lacking one very important thing, and that's trust. See, governments don't really support cryptocurrency because it actually affects their ability to collect tax. So until governments can work out a way to solve that tax collection problem with cryptocurrency, then I really don't see it as a threat to the banks at all. But it is a very interesting space, and it is something that I'll need to probably continue to monitor. See, I believe that betting against corporate America is not a smart move at all. These big banks and big corporations have a lot of influence over the government. Personally, I don't like how most governments are really easily manipulated by corporations, but it is the world we're living in. So to bet against corporate America, I don't think is very smart. But there are some serious challenges on the horizon. A threat to the big banks are the fintech startups. Think like Lending Club, Square, Robinhood. They don't have to deal with bureaucracy, and they also don't have to deal with all the old technology that's inherent in banks. And I think they're going to catch up really fast if the big banks don't evolve. But honestly, I think the banking sector should be most worried about the likes of Amazon, Google, and Apple. They have big, powerful brands, devoted fans, and a lot of money. So if any one of them was to try to make a serious move into the banking space, well, I think that would shake things up a lot. But the banks have one thing that these big tech giants don't have, and that's enormous amounts of client data. And this is where the opportunity lies for a big, trustworthy bank. See, they have records on all the transactions that you make. So imagine in the future where you have some AI manager who was always going through your transactions and your income and tailor making credit cards for you or debit cards, getting you the best interest rates, reducing all your fees for you. This is where big banks can take a big step forward. But if they don't move on this, I think the advantage that they currently have is going to get eaten away by those either big 3 tech giants or by other fintech startups. Look, this is just total speculation, but maybe the next big banks are going to be Amazon, Google, and Apple. And as Wayne Gretzky said, to be successful, you need to skate to where the puck is going to be, not where it currently is. So we must ask ourselves, which of these 4 big banks do we think are going to adapt and then be successful? Okay, first let's look at JP Morgan Chase. Now, in 2008, they actually handled the crisis better than all the other banks and actually performed profitably throughout. And this performance through the GFC has actually set them up over the last 10 years to be the biggest of the big 4 banks. Look, they're still a big, slow-moving bank, but they are the most popular of the big 4 banks, so that does give them quite a good advantage. They've also just allocated big reserves for the next 3 to 6 months because they know that it's going to be tough for a lot of small businesses to pay back their loans. This is a very smart first step, and it'll be very interesting to see whether they can get through this crisis profitably like they did last time. Now, Bank of America actually hardly made it through the 2008 crisis, unlike JP Morgan and Chase. And I think what hasn't killed them has made them stronger. See, prior to 2008, they were this big fat bank, but now they've become really lean. And they have acknowledged recently that the future is high tech, and they've started to try to integrate AI into their systems. But they are no tech company. Bank of America have also allocated big reserves for the likelihood that a lot of their debts are going to go bad. We'll get to their financials to see how strong they actually are. Citigroup, or Citibank. Now, I think the most interesting development with Citigroup is that they've partnered with Google for some consumer services. Now, I actually think this is a smart play from Google to tap into the banking world. See, the banking world is actually really hard to crack into, so maybe this is Google's first step into the lucrative banking world, and maybe there's a bigger partnership coming in the future. And Citigroup has a far more global presence than the other banks, but that doesn't really matter in the current financial crisis because the whole world is really affected. And finally, Wells Fargo. They are by far the most criticized of the big four banks, especially of late. In 2017, they were doing some pretty bad things. What a lot of their employees were doing were they were creating actually fake accounts to get bigger bonuses. See, the incentive structure at Wells Fargo really encouraged this bad behavior. But when everything seems to be going really bad for a company and it looks like it's at its weakest from the outside, this is often when the best opportunities exist to buy an 150-year-old bank at crazy low prices. But we're really going to need to check those finances carefully. So like JP Morgan Chase and Bank of America, Wells Fargo have allocated big piles of resources to make sure they can get through the next 3 to 6 months of most likely a lot of debts going bad. See, Wells Fargo are in the mortgage space generally, not the corporate world like Bank of America and JP Morgan Chase. So they deal with a lot of consumers. So because a lot of consumers have lost their jobs, their mortgage repayments are going to be hard for them to make over the next 3 to 6 months. So let's go now take a look at all their financials to see who is in the best position. So first they're going to see whether they can manage their debt, whether they're growing, and then we'll see whether they are a well-managed company. And these are the 3 key areas to determine the health of a business. And I've developed these by studying Warren Buffett, Bill Ackman, and Benjamin Graham, who are legends of investing. Now, definitely don't worry about the terminology too much. If you can just get the overall picture of what I'm talking about, then that's perfect. Now, the banking sector is actually fundamentally a lot different to the other sectors, so we actually have to look at debt in a different way. So banks, they're actually in the business of debt, and they actually always carry high debt. So this is very normal. So for banks, what I'm looking for is how big is their allowance for bad loans? How risky are their liabilities? What is their loan level? And what is their bad loan level? See, if the bank has a lot of safety for bad loans, then they're probably going to get through this crisis without any drama. Now, if we look at this table, 3 of the 4 are strong, with the exception of Wells Fargo being quite a far distance back in its allowance for bad loans. That's not a good sign. So for JP Morgan, Bank of America, and Citigroup, they all get a tick, whereas Wells Fargo, they get a cross. Next, we're going to look at whether the companies are growing, and this will be more of an indication pre-crisis because a lot of the data hasn't come out yet for the April, May, June period, which is what we're currently in, and that's going to be the most severe of the crisis. But we definitely want to see whether they were growing pre-crisis. So what we're going to look for is their book value per share, their earnings per share, and their operating cash flow. Okay, JP Morgan. The only concern here with JP Morgan is that they are not generating enough cash from operating activities. So that's a cross. Now on to Bank of America. And although this looks a little bit better than JP Morgan for operating cash, the inconsistency across these graphs is something I don't like. So that's also a cross. Now with Citigroup, their book value per share looks good. But like Bank of America, a lot of inconsistency, and it also has bad operating cash flow. So that's also a cross. And finally with Wells Fargo. And again, inconsistency from earnings per share and operating cash. So another cross. Well, this was interesting. I actually didn't expect all 4 of these banks to fail my test. But my tests are quite strict because a lot of analysts would normally just look at the book value per share and see that growing and be fine. But for me, I like to be strict because I want to find the best companies I can. Now, it doesn't mean they're uninvestable. We're just going to need a really big margin of safety. Now we'll see if the companies are well managed, and we can't obviously talk to the management team directly, but there are some telltale signs in the financials to tell us whether they're making some good decisions. Now, like I've said before, banks are actually quite different to other stocks in the stock market because they use debt to make their money. So we're actually going to have to change some of my normal criteria that I look at a stock. We're definitely going to still keep return on equity, but we're going to use some other ones. I also want to look at the return on assets, the net interest margin, and the efficiency ratio. These are pretty typical things to look for in a bank. Now, return on equity is how much money the business generates for the shareholders. And as you can see, JP Morgan is the best at this by a reasonable margin. Return on assets is how well the bank is using all of its resources. We want to see this around about 1% for a bank. And JP Morgan and Bank of America are only on the industry average. It's a pass, but it's not great. The net interest margin is a very important number for the banks. It is the difference between the interest the bank receives and the interest the bank pays out. 3% here would be good, and Citigroup has the best net interest margin. A solid dividend would be good too. They all pay a dividend, but don't get too excited about that Wells Fargo 8% dividend. They have quite a high payout ratio, and I think the dividend is going to be difficult to sustain. So JP Morgan, Bank of America, and Citigroup have just passed this stage, and Wells Fargo has not passed the stage. Now, the reason I'm accepting a low net interest margin is because they actually don't have a lot of control over the interest rate, because the Reserve Bank of America will set the interest rates and the banks just get squeezed every time that gets lower and lower. So we want to see a higher net interest margin in the future, and I think over the next 10 years, it will probably come back to some sort of normality. If you like this type of video, you should definitely subscribe to my channel to get more videos like this and to help me grow. Now back to the banks. So they didn't pass all my criteria, so I'm not overly interested in investing in any of the banks at this stage. Growth was really the issue, and the low interest rate environment that we're currently in really does hurt the banks. But eventually, I do think interest rates will return to normal at some point, and it'll make the banks far more profitable. But if I go see what the analysts think about growth, the average growth rate for each bank is here. As you can see here in this table, this is actually what the analysts think the average growth rate will be for each of the companies. Besides Citigroup, the analysts are of the opinion that the banks are going to grow over the next 5 years at around about 5%. So far, I think JP Morgan and Bank of America are the stronger two banks. The future of 5% growth is okay, and they nearly passed all of my criteria. JP Morgan is the more popular of the banks, and Bank of America is incorporating tech more into their business. But I have seen better companies before, like Google, for example, and if you haven't seen my Google video yet, maybe you'll enjoy watching that one. So mostly for interest sake, I wanted to run them all through my new fancy intrinsic value calculator. And if you want your own version of my calculator, it's free and you can download it just in the link below. It's in the description. And I made a full tutorial on how to use the calculator a couple of episodes ago. So go back and watch that for the explanation. And here are the results. Now, I wanted to be safe and use a good margin of safety, because the banks have not shown a perfect score that I would like, but it also wasn't that far away. So I am choosing my second level buy price. If that makes no sense, I explained it in the intrinsic value tutorial video. And for now, it's simply the price I want to pay. Well, Bank of America, you are a serious bargain right now. My second buy price is a very conservative number, and to still be 30% below that, it's actually kind of hard to believe. It is an insane bargain. And now this is an exceptional opportunity for me to explain risk versus reward. They failed my growth metrics from earlier, mainly because they were inconsistent, but they did pass the other two criteria. So they are definitely not perfect, but to buy the second largest bank in America at an insane price, well, that's going to be too hard to say no. And I 100% honestly was not expecting to buy any of these banks. So let me explain why this low price has persuaded me. So imagine you are a mechanic and you're looking for a car. There are a lot of good new shiny cars on the market, but you notice this older second-hand Toyota Corolla. Now, as a mechanic, you actually know how much the parts of this car cost. If you were to chop up the car and sell off all the different parts individually, well, you would get around about, say, $3,000. But the salesman comes over to you and says, oh, I don't really want that car anymore. You can have it for $2,000. You walked in to get a really good car for your family, and you still are looking for that car. But when you know something is worth far more than $2,000, well, you take it and you ask whether he's got any more. And that's pretty much exactly what's happening here with Bank of America. If you bought all of the shares of Bank of America and then split up the bank into all of its different parts and sold them all off, you would make money. So what I'm talking about is that its current price represents 80% of its book value. A company normally only trades below its book value when it's in a steep decline. But as you can see, it isn't declining at all. A more reasonable valuation would be maybe 120% of its book value, which is about $40 per share. Yeah, I know the company is not as strong as companies that I've looked at in the past, but the margin of safety is so good that a lot of things can go wrong, and my investment is going to be totally okay. And if they can just keep doing their normal business and get through this crisis, then I'm going to benefit greatly. It is the second largest bank in America. It is profitable. It has a solid return on equity. They are integrating tech into their business, and I do think the banking industry is going to play an important role over the next 20 years. So this was a really cool chance to show you that it's not all about one criteria. I do need to go through each of those criteria and look for really big red flags, but just like in this case, the company doesn't have to be perfect. If the margin of safety is so large, well, the risk reward is totally worth it. So Bank of America, at your current insane price, you are JP Morgan, Citigroup, and Wells Fargo, you are Well, I hope you enjoyed that curveball. I really enjoyed that. It was very unexpected. I even found that all a little exciting. I'm such a nerd. Please subscribe to my channel to see more of my videos, and don't forget of the free intrinsic value calculator in the description below, and I will see you in the next video.